The big question I have is another rally in the bond market, these record low yields in Germany, Spain, Portugal, you name it. What does that signify to you, Katie? What is the reason for it?
I think it's three things, Alex. I think it's a re-rating of inflation and inflation expectations. Clearly, we've seen that in the data. I think it's the geopolitical risk that you've been talking about all morning related to not just the trade issue, but now the issue with Iran. And then thirdly, I think now it's a re-rating of global growth expectations. And I wouldn't have said that necessarily a couple of weeks ago, but even here in the U.S., you're seeing growth expectations come down.
And yet, Kathryn, we see employment strong, not just in the United States, but in Europe and elsewhere. I mean, there are some indications the economy is not really suffering as much as the markets might indicate, particularly the bond market.
That's right, David. Employment is strong and consumer confidence, particularly in the U.S. front, is high. So you have confidence very high, but you have treasury yields very, very low. So that spread differential calls my attention. I think that the bond market is overpricing the amount and the magnitude and the speed of Fed cuts. I think the market is going to be disappointed, which has important repercussions both for treasury yields, which intuitively I think go higher from here, and equity markets, which will re-rate lower. The fact is that there is not much inflation, but if in fact Chair Powell is correct in what he said, 2 months ago, which is that the deflationary impulses are transitory in nature, then the Fed doesn't have to cut and shouldn't cut 3 to 4 times over the next 6 to 12 months.
So you say usually the thing is don't fight the Fed.
Right.
How do you fight the bond market, though?
Right.
Every time you do, you've been hurt. Not
Yeah,
you,
you're right.
One has been hurt.
You're right, Alex. And the bond market vigilantes are out. The bond market is basically taunting the Fed not to cut. So what does the Fed react to, right? I mean, the Fed's credibility is at stake once again. And the Fed has had issues with credibility over recent years. What are the dots plots going to show us next week? That'll be interesting. And is the Fed going to succumb to market pressures, or is it going to respond adequately, and as it should, to its dual mandate and to the state of the U.S. economy at this juncture?